Self-employed and wondering what motor expenses you can deduct? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, for self-employed people, the cost of the cars, vans, other sort of travel is always an interesting topic. And I thought it was about time that I refreshed the video on this, because there is a classic video we did a few years ago that kind of touches on this, but doesn't go into some of the other details. So on this one, I wanted to talk to you briefly about what travel is from a tax point of view in brief, and then the couple of ways that you've got dealing with your motor expenses. So before I get into this video, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So let's start off with the basics. You can 100% get tax deduction for your travel. So if you remember, the basic kind of rule for self-employed people is that if you're incurring a cost wholly and exclusively for the use of that kind of trade, then you can generally get a tax deduction. Now, if only it were that simple, we wouldn't need accountants and all these complicated tax rules. Unfortunately, there are a lot of caveats to this. So travel being one of them. The travel rules over the years have seemed to have got more and more complex. So I think it's worth coming back to the same rule that yes, travel is deductible, but you do have to think about it as a self-employed person. And what I should say is that the self-employed rules are different to the limited company rules. They share a lot of kind of similarities, but they are different. And one of the core concepts you have to know about in the self-employed world is where is your base of operations, and it's worth thinking about. Now, the reason this is important is if you imagine, if you've got a normal paid job, when you go to work to and from your office, for example, where you work, where your employer is, you're not going to get a tax deduction. There's no tax relief for that. And I think it's a bit of a misunderstanding that self-employed people suddenly do get a tax relief for all of their travel, and that just isn't true. It's very similar. So if it looks and feels like commuting, the chances are you're not going to get a tax deduction. It's all because of the base of operations rules. So there's a recent court case, which is probably not that recent now with COVID, it's all flown by, but there was a court case where a doctor, for example, he said his base of operations was his house. He kept his medical books there. You know, he wrote up his books and did his bookkeeping at home. Therefore, effectively his base of operations was his house. So he thought he should be able to have travel between a couple of hospitals that he went to and then to patients' homes for individual visits. Now, that makes logical sense, but the courts disagreed with him. What they said was, actually, we think that the two hospitals are separate bases of operations. You know, you're going there every day, like commuting, it's regular and predictable. So they said, we're not going to let you have that. We're just going to let you have the travel from your house to the patient's homes because we get that. That makes sense to us. But the other two are basically you're moving into a separate base of operations. So if you were thinking, like, let's say you're a tradesman and every day you drive from your house to a site where you pick up another van and then you go out and about on your travels, that travel from your home to the site, regular and predictable, feels like commuting, is not going to be tax deductible. So let's just say you've travelled from home to the yard and you're picking up the van there. There's also your vehicle for business, because you can have multiple vehicles for your business, and you're incurring costs there. It's more likely that the travel then to all the different places, let's say you're a bricklayer and you go into several different houses and sites throughout the day, that's more likely to be claimable. So just bear that in mind. I could do a whole video on that, but if you just think about that, if it looks and feels like commuting, it's unlikely to be the case that it's going to be deductible. But then knowing those rules, what can you deduct? We've got two main ways of doing this with motor. You can either kind of claim all of the costs, including potentially the cost of the car, and put that through, or you can claim a flat rate simplified expense mileage claim. So the Revenue and Customs say, here's a grid, depending on how many miles you do in the year on those business journeys we just spoke about, we're going to give you a mileage allowance. So let's take both in isolation. So let's start with the mileage one, because I think that's the easiest. Keep a mileage log of all those business journeys. We just talked about what a business journey might look like. So you keep a log. First 10,000 miles at the time of recording this video is 45p. There's people arguing that should be more now. Now, previously I'd have said to you, well, 45p, if you work that out, is easily going to cover your fuel, because the idea is that rate has in there that also that your wear and tear on your car and things like that. So it's always more than the fuel. With fuel prices these days, it probably needs to move, but that's where we are. Over 10,000 miles is 25p a mile, and there's also an allowance that's a little bit cheaper there for motorcycles. So do know that any business vehicle has those rates, and that's it. You simply keep a mileage log, claim that. Now, because these are an option, you can either do that or you can do the full expenses. A lot of times you weigh up the odds, which one shall I do? And I would have said the majority of people over the sort of lifetime I've been doing this would have ended up at mileage, because it tends to be, in the majority of situations, the more that you get a bigger claim basically. However, it's not always the case, so do the maths. That's the easiest one. You got mileage log. If HMRC ever looked at it, you can show them that. Very straightforward. The other one is you're going to have to keep great records, because you're going to have to put through all of your actual costs. So that's, your insurance, your fuel, any oil, just anything that's to do with that running of that vehicle, be it a van or a car, doesn't matter. It could be multiple vehicles if you had a business that was using multiple. And then what you do is you add all that up and then you work out, actually, If your vehicle is used in any way personally or it's available to you, you just think, well, let's calculate a fair sort of add back, if you like an amount you're going to disallow. So you might say that actually 80% of the time it's business, 20% is personal. Now, the trick to this is if the revenue looked at it, you have to be able to say how you came to that percentage. So you might actually want to still keep a mileage log. That would be the sort of the preferred way of doing it, really, is you just have a mileage log and say, look, I've done all these miles. Yeah, it worked out 20% on average that I'm actually using it personally. So do that. And it can be, you don't have to keep every mile particularly. What you could do is just keep a log of all of your business journeys, and you know what your start and your finish mileage at the end of the year is. So you'll be able to tell with a quick bit of maths there what you ended up with as a percentage. And what you do is, you only put in your box in your tax return, you only put in the amount that you're going to claim. So if it worked out that 80% of the figure was your business use, then you're going to put that 80% figure in your tax return. Now, where it gets slightly complicated though with these is the actual cost of the car. So generally, I'll say car could be a van, and that's really important, and this is where it's probably another video, but there is different tax treatment for the cost depending whether it's a van or a car, and depending on the CO2 emissions if it's a car. And that's really big, because what they don't tend to do, if it's a van, there's a good chance you might get 100% of the value of that van off against your profits in the first year under these capital allowance rules. If it's a car, then you might only get 6% a year, for example, depending on the CO2 emissions. But it's a separate set of rules, probably a separate video, but do Google capital allowances if you're going to go and do that. And again, if you've got any personal use, you're going to have to disallow an amount of those capital allowances. So you can say that actuals is a bit more complex, but it can work out quite well. Like if you've got an expensive Land Rover or something and your costs are, I'm not just picking on Land Rover owners here, but there's just one we see quite often. If you've got an expensive Land Rover with all these running costs and high insurance and tax and everything else, and you use it a lot for your business, for those qualifying journeys, you might find that is actually a better way of doing it than the mileage. But sort of have a look, weigh up the two, and go from there. So there's the summary, but one final thing before you go. Do know on VAT, if you're a VAT registered sole trader, there are a separate set of rules around vehicle costs and VAT. Do know that it's likely you're going to be able to get some VAT back on those kind of running costs and potentially fuel. But when it comes to the actual purchase, if it's a car, it's very unlikely. But little tip there and something to look into for sure before you go claiming back all the VAT on everything. There are very specific rules and it is a bit of a red flag, so definitely keep an eye and research that. So that's it. Please do share this information with anybody you think needs to know it, and I'll see you in the next one.